You're listening to the Unlocking Financial Freedom podcast, episode number 3. In today's episode, I'm continuing with our series on achieving financial freedom through personal financial planning. And in today's episode, I'll be talking about the wealth creation pillar of financial planning, as well as the social media competition I'm hosting. Stay tuned. Hello, sanibonani njani, and welcome to episode number 3 of the Unlocking Financial Freedom podcast with Chief Kasi Economist Samkelo Magoqo. I'm your host, Samkelo Magoqo, and I'm happy and excited that you've taken time to listen to this episode of my podcast. This is part 3 of 4 of the series on achieving financial freedom through personal financial planning. And I'd like to recap on the first and second episode for those people who weren't able to join us on this episode. So in part 1 of the series, I introduced you to the concept of personal financial planning and explained how it can help you achieve financial freedom. And I introduced you to the 2 pillars of financial planning, which are the wealth creation pillar as well as the wealth preservation pillar of financial planning. I then introduced you to a methodology known as the 6-step financial planning process, which is used by financial planners to help you, guide you in your personal financial planning activities and so on. And I then moved on to episode number 2. And in this episode, I fully dedicated it to the wealth preservation pillar of financial planning. And this was more like a counterintuitive interpretation of financial freedom, because the nature of financial planning requires you to start with the risk planning part of financial planning and not necessarily the wealth creation part. And most people start with wealth creation activities. They start with their investments, their businesses and so on, and they forget about managing risks and so on. So financial planning starts with risk because you don't know when those things would happen and so on. That was the second episode where I was talking about the wealth preservation pillar of financial planning. If you didn't get a chance to listen to those episodes, I suggest you check them out after listening to this one, or you go back and listen to them first and come back to this one. In today's episode, I'll be taking you through the wealth creation pillar of financial planning, and I'll share with you 6 strategies you can use in your wealth creation activities. Now, I know a lot of people are excited about this one because we all want to have more money, we all want to have more wealth in our lives. So I want to share these 6 strategies with you, and I'll start with the strategies that need minimal work from you. And as I go on gradually with the strategies, I'll then have strategies that require more effort you can use in your wealth creation activities. Now, I know a lot of people are excited about this one because we all want to have more money, we all want to have more wealth in our lives. So I want to share these 6 strategies with you, and I'll start with the strategies that need minimal work from you. And as I go on gradually with the strategies, I'll then have strategies that require more effort from you. So let's get into it. Before I share with you these 6 wealth creation strategies, I want to start with defining what wealth is so you can apply this to your wealth creation goals. What is wealth? Investopedia defines wealth as the value of all assets a person owns, including savings, property, or other items, minus all their debts. So you have to understand that you take into account every asset a person includes or a person has, the value of those assets, and then you say less all of their debts. And the financial term for assets less any outstanding liabilities is net worth. It's basically the net worth of that person. So for a moment, I want you to think about the Forbes list. Everyone loves reading about the Forbes list and the world's richest or wealthiest people and so on. So when you think about the Forbes list and the net worth specifically, when they say Mark Zuckerberg is wealthy or Mark Zuckerberg is in this number or on the list. Mark Zuckerberg, by the way, is the person who created Facebook. Or they talk about Oprah Winfrey, or they talk about Bill Gates. They specifically quote the wealth of the person. They don't quote their riches or their cash and so on. They quote the wealth. So wealth includes assets, which also has cash, land and buildings, investments, paper assets, and so on. So now, for example, if you own a house that is worth 2 million rands and you have an outstanding amount of 1 million, you still have to pay on the bond which you use to finance your house. Then your net worth would be 1 million rands, because 2 million less a million is 1 million rands. So that would be your net worth. This is why you would need to have life cover in place to cover you in the instant that you pass away and you haven't finished paying for your bond. Then that life cover would cover that outstanding amount on the bond and would make sure that your family that you're leaving behind still have their house and so on. That's what wealth is. Wealth is the amount of assets you have less the liabilities you have. Another way to think about wealth is to think of it as a stock of assets that give you a stream of income. When you think about a house, for instance, if you have a house and you're renting it out and you're getting an income, the house is your stock of wealth and it gives you a stream of income through the rentals you receive. Or if you think about an investment in shares, for example, shares are your stock of wealth that give you a stream of income through dividends. So that's why you consider shares as wealth and so on. So think about wealth as a stock of money or of an asset that gives you a stream. Take a short ad break, and when we come back, I'll start with those 6 tips to achieving wealth creation. So let's head on over to the break. See you after this. Hey guys, sanibonani ninjani. I'm Chief Kasi Economist, and I'd like to share an exciting competition I'm hosting on my website. The winner of the competition will walk away with a registered company as well as a well-designed WordPress website. So listen up on how you enter. Step 1. Log on to YouTube and search for my channel, which is Chief Kasi Economist. Once you find the channel, the first thing you'll do is that you'll subscribe to it and then share any of the videos you find on the channel on Facebook with the hashtag Samkelo MAG, Samkelo Mag. Then the second step is that you log on Facebook and search for Chief Kasi Economist again. Then you'll find my page, and the first thing you'll do, you'll like the page, and then after liking it, share the page on your Facebook profile with the hashtag Samkelo Mag or Samkelo MAG. The grand prize, as I said, includes a registered company and a well-designed WordPress website. So get on the competition and start entering. Welcome back, guys. I hope you guys are excited about the competition I'm hosting on my social media platforms. So you guys know what to do. So you need to enter the competition and get a chance to win those amazing prizes. And another important thing I wanted you guys to know is that the winners of the competition will be chosen through the post engagement metrics of Facebook. So you need to tell people to like your post, to react to it, to share the post. So I'll be taking into account the likes, the shares, the reactions, and counting them up. And the person who has the most likes, reactions, and all those engagements will win the competition. This excludes post comments specifically. It only includes the reactions and likes as well as the shares. So you need to know that that's the criteria for choosing the person who will win the competition. So you need to ask people, once you've shared the page on your profile and you've shared the videos and everything on your profile, then ask people to engage with that, so that when I'm tallying up all the numbers, you may win the competition and so on. So this is also on the competition T's and C's. I'm just pointing it out for those people who don't know and so on. So let's get into the wealth creation tip number 1. And this tip is basically about being savvy about your money, and that you just need to be proactive about managing your personal finances. That's the first tip. Because according to reports published by the South African Human Rights Commission, an estimated 40% of the monthly income of South African workers is being directed to the repayment of debt. So you can imagine that if 40% of salaries of a person goes into paying debt, how much more is left for investing, saving, starting your own business, taking into account day-to-day expenses and so on. So it's quite important that you know where your money goes. And the first thing you could do is you could start by budgeting and accounting for your money. Now, a lot of people will tell you they have a mental budget. They know how they spend their money in their heads. And some people will say they have a written budget. That's not as complicated, but they write it down. While others will tell you they have a detailed budget with a spreadsheet in place, and they know where every cent of their money goes and so on. Whatever type of budget you have, even if you have a sophisticated one through an Excel spreadsheet, or you have a simple one where you just use pen and paper, it's quite important to have your budget because it helps you live within your means. It also helps you become disciplined and know where your money goes. And you know which debts you have, which debts you must pay first. You know how much you spend on your groceries, how much you spend on your car and on your entertainment and everything. It's not like you'll be rich overnight, but you'll know where your money goes, and you'll start seeing patterns in your spending where you maybe waste a lot of money, or where you use a lot of money unnecessarily and so on. So the first tip is about being proactive and being savvy about your money and budgeting and so on, and checking your personal finances and how you spend your money. This doesn't require you to be a financial planner or someone who is financially equipped and knows everything about finances. It just requires you to just know your money. It doesn't require you to have a lot of money too. It just requires you to just know your money. And wealth creation tip number 2, this is somewhat counterintuitive again, and it's something you wouldn't really think about. Now, if you want to be a wealthier person and increase the money you have, you should become a giver and a tither of your money to the needy and to the church. Now, my mom always makes an example about a certain church group, Abantu Basewese. These people focus a lot on giving and tithing, if you notice, especially in the Eastern Cape. You'll find that kukhona abantu ababaweselu, people who aren't, if I would say, if I put it this way, abanganakile indaba evangeli nokusindisa, but they live within godly principles. So you'll find with a business person, mhlawumbe usonto weselu, uzovele akhe isonto, just create or build the house of the Lord. Akhe isonto, And this person will be blessed for a long time in their lives and their family and so on. And another example I'd like to make, think about the rich people, the wealthiest people in the world. They like to call themselves philanthropists. Think about Oprah Winfrey, think about Richard Branson, Bill Gates. All of these guys have foundations and they give back to the economy. And recently, I saw Trevor Noah at the South African Parliament. Our President Cyril Ramaphosa actually introduced him and talked about a foundation he has that he's heading up. The foundation offers, I think, bursaries, but it focuses on education and so on. Even Trevor is a wealthy person and he's starting to give and he's starting to be a philanthropist. Why do you think these people do these things? It's because they want to have more money. It's counterintuitive, I tell you. And in the church, we are constantly, told or constantly taught that we should give to the Lord, we should give to the needy, that we should pay our tithes. We actually pay tithes like we pay taxes because we belong to the kingdom of heaven. And in the kingdom principle, there is taxes. Taxes are paid even on earth. You pay taxes to the government so that the country that you live in may be maintained. We also pay taxes so that the kingdom may be maintained in the earthly perspective, at least, in that things need to be done by money. Money is a resource and whoever has it has power. Money has power and money is the answer to everything, the word of the Lord says. I encourage you to be a giver. Give to charities. And if and you're born again, you can start tithing more and focusing more on tithing and so on. But the principle of giving is quite important. And the more you study about giving, you'll see that a lot of people who are givers actually reap more rewards in their life and become wealthier and so on. Even giving with helping people, being someone who helps and gives out information, you'll be a wealthy person if you are a giver. So that's wealth creation tip number 2 that people really wouldn't think about, but it's quite important for you to do those. And number 3, wealth creation tip number 3 is all about using the tax breaks you get from the South African government. South Africa has one of the lowest saving rates in the world. And even if I don't quote any figure, you guys know this. Most South Africans retire and they are dependent on the state pension when they retire. Most South Africans don't have enough money to fend for themselves. And for those who work, they don't really save a lot of their money. So South Africa is one of the lowest saving rates in the world. And to increase this number and the percentage of people saving in South Africa as a percentage of the gross domestic product, the government has various tax incentives it offers to citizens to encourage them to save more and to invest in financial markets. So now, for example, you have a lot of tax breaks that you can use as an individual. So if you are an individual who is below the age of 65, you can receive tax-free interest from your investments up to a maximum of 23,800. So that is your tax exemption from the government. Another provision made by the government is the tax-free savings account, which allows you to contribute up to a maximum of 33,000 in a tax year. And those amounts that are contributed to a tax-free savings account will then be invested in different financial assets in the stock markets and so on. So up to a maximum of 33,000 in the tax year can be contributed. So that's an annual contribution. And one thing to note is that if you contribute amounts in excess of 33,000, then any amount in excess of that is taxed at 40%. So if you contribute 43,000, then that 10,000 that is extra, you will be taxed at 40%. So 4,000 of the 10,000 will be taxed. So here, it's quite important to understand that the tax-free savings account option is aggregated across accounts. So you might have a tax-free savings account with Standard Bank. You might have a tax-free investment with Old Mutual, with Easy Equities and so on. And you're investing in these different tax-free savings accounts and so on. And if it happens that you pass the limits of 32,000 across all of these accounts, then any excess amounts will be taxed by the government at 40%. Another important thing about tax-free savings account is that you have a lifetime limit of 500,000 you can contribute to this account. Now, any growth amount that exceeds 500,000 is still your money. You won't be penalized, but you can contribute up to 500,000 in your lifetime to this account and so on. I don't know how National Treasury will check all of this, that how much have you contributed over your lifetime, taking into account that maybe you might withdraw some money during your lifetime and so on. But National Treasury will have their own ways of checking it out. But you have a lifetime limit of 500,000, and any growth then that happens within the account that is over 500,000, then that amount, you won't be penalized on that. So a tax-free savings account basically enables you to have investments that won't be taxed. You won't incur dividend tax, you won't incur capital gains tax. All the investments that are held in your tax-free savings account vehicle will not be taxed. They will essentially be tax-free. So that's another tax break you can use. Another tax break you can use is when it comes to pension funds and retirement planning. So when it comes to retirement planning, you have these benefits. If you have a retirement fund or a pension fund with your employer, or you are using retirement annuities that you buy through a financial services company, you are allowed to deduct contributions made towards any pension fund in South Africa. So you are allowed to deduct on contributions up to a maximum of 27.5% of the greater of taxable income or remuneration, with a maximum deduction of 350,000 per year. The 27.5% is a cumulative percentage, and contributions are kept at 350,000. So as soon as you are paid or you are remunerated with 1,272,727 rands and 30 cents per annum, then you would have reached that limit, because if you take that amount, which is 1,272,727 rands and 30 cents times 27.5%, then you will reach that cap, which is 350,000. So if your remuneration or your taxable income is that amount, then you reach the cap of 350,000 per annum. You might be asking yourself now, what is the difference between remuneration and taxable income? Because this deduction applies to contributions up to 27.5% of the greater of taxable income or remuneration. So what is the difference between remuneration and taxable income? Remuneration includes all amounts received from your informal employment, such as your salary, your leave pay, your wage, your overtime, and your bonuses. That is remuneration. On other activities that you do on your personal capacity. So let's say you receive your formal salary from your employer, as well as bonuses and other fringe benefits from your salary or from your employer. So like you get your salary, your fringe benefits and your bonuses, that's your total remuneration. And then let's say you also have a house that you rent out. And in this house that you rent out, you receive rentals on a monthly basis from your tenants. So when you add that amount into your remuneration, that amount then will become your taxable income. It will include your remuneration as well as other income that you've derived from business activities and so on, and from other activities. So that the difference between remuneration and taxable income. Remuneration is from your employer, and taxable income includes amounts that you also have on the side if you have side businesses and so on. Now, let's move on to wealth creation tip number 4. This strategy is about you investing in financial markets, investing in the stock market, investing in the forex market, the bonds market. So when you invest in the stock market, you can do it directly or indirectly. If you do it indirectly, this basically means that you buy financial instruments, financial securities through collective investment schemes offered by financial services companies and intermediaries. This indirect investment will come in the form of a contractual savings vehicle or a non-contractual savings vehicle. So let's differentiate between the two. A non-contractual savings vehicle means that you can buy, for example, unit trusts through a linked investment service platform. Allen Gray offers this, or Mutual offers this, without an advisor. So when you, like Satrix offers this, check out Satrix, check out Allen Gray. When you buy a retirement annuity or you buy a unit trust and you buy those assets without having an advisor giving you advice, and you buy them through these linked investment services platforms, then you are indirectly investing in the stock market, because when you invest in a unit trust or you invest in a retirement annuity, those funds are ultimately invested in the stock market, and financial securities such as shares and bonds are bought with those funds that you invest in those retirement annuities. So ultimately you are investing in the stock market. It's just that you are doing it indirectly, not buying shares directly in the stock market. So in this form of non-contractual savings, the layer of advisor fee is not here. So you would save on the advisor fee layer, but you would incur platform fees, because the linked investment service platform comes at a fee. Accessing that platform comes at a fee. Now, the funds that you invest in, so if you invest in a retirement annuity through a linked investment service provider, that amount of money you invest on a monthly basis will effectively be invested in stock market, in shares and bonds. Who buys those shares and bonds? It's an asset manager who buys those shares and bonds. The person who will collect the amounts from the different people and invest them in financial securities. So that person also charges an asset management fee, or that group of people charge an asset management fee. So you would incur platform fees, you would incur asset management fees, because asset managers need to choose those investments on your behalf and so on. Okay, so there is a non-contractual way of investing indirectly in the stock market. A contractual way of investing directly in the stock market would you buying unit trusts again, or buying retirement annuities, but through a financial advisor perhaps, and through a contracted term. So if you're investing, let's say 500 rands per month for a 10-year period through a plan that says you must invest this amount every month over the 10 years. So the contractual part of savings requires you to commit to a premium paying term. And if you break this commitment by disinvesting, you then incur a fee. So if you come to an advisor and you say you want to invest for like 10 years, a premium of like 1,000 rands over 10 years, that will grow every year at like 10%. And you commit to this and you say you'll do this over 10 years. If for any reason you want to withdraw your money after 3 years, let's say, then you'll be charged a transaction administration fee, which is basically the administration of disinvesting your amount. But over and above that, you'll be charged a penalty because you didn't commit to your 10-year term. So there's different methods. There's non-contractual methods and then there's contractual methods. So ask your advisor about the contractual methods of investing in financial markets and the non-contractual methods of investing in financial markets. If you don't use an advisor, then you figure it out on your own. Now, directly investing in the stock market basically means that you are buying shares that are listed on a stock exchange through a stockbroker such as Easy Equities, for example. Or you are buying exchange traded funds, which are collective investment schemes, just like unit trust, but the difference is that they are listed on a stock exchange. So through platforms such as ETFSA or through platforms such as Easy Equities and so on. So you need here to have a brokerage account which will allow you to buy and sell shares and exchange trade funds through this account. Now, take note that here you will need to pay a brokerage fee every time you buy and sell shares. So this is a fee that is a percentage of your transaction, because the platform provider basically earns a fee when you buy and sell shares on their platform, or you buy and sell exchange traded funds on their platform. This is the great part, is that you don't have to pay advisor fees here, because you are investing your own money in the stock market and you are basically choosing the type of shares you want to buy and so on. With that said, the biggest risk factor to investing directly in the stock market is that you will have to formulate your own investment strategy, which will inform the type of shares and ETFs you want to buy. Now, a rule of thumb, if you're starting out investing directly in the stock market, is that you must first invest in exchange traded funds as opposed to investing in shares. Investing in whole shares means you are taking the whole risk of that company, but if you invest in an exchange traded fund such as the FINI 25, for example, or an exchange traded fund that indexes the JSE Top 40 or the FINI 25, it means that you are investing in a diversified pool of financial securities. That ETF basically buys equal amounts of the different companies that make the Top 40 index or that make the Financials 25 index. Then you buy that piece of an asset, which is an exchange traded fund that invests equally or in different proportions to these assets or to these shares that are within this index. Then that means you are diversified. If one company in the top 40 goes down or goes bust, there are still other 39 companies that are there that can perform well, and the risk over time cancel each other out and you get a smooth growth over time. So choosing to buy exchange traded funds over whole shares means that you'll be able to diversify when you're starting out. And then once you are well informed about investing in the stock market, then you can start in buying shares at Standard Bank, buying shares at FNB, Old Mutual, or whatever, and move away perhaps from investing in that FINI 25 index, which tracks the top 25 companies in the financial services industry and so on. If you have an online trading account, then that means you can trade in different financial securities such as derivatives, such as currencies or shares and so on. This is another way to make money in financial markets, but I do encourage you to first focus on the traditional investments in financial markets, and then later focus on these exotic and more riskier methods later. But start with investing through collective investment schemes, investing through retirement funds and retirement planning and so on. So yeah. So wealth creation tip number 5. The wealth creation strategy in number 5 is all about personal development. If when you want to earn more money in your life, you can simply become more valuable and charge people more money for your services or to access you and your time. More also and in context of an employee-employee relationship, you can take an accredited industry-specific short course, for example, so you can become more valuable to your industry and to your company. This way, you can ask for a raise. Also, if you check out lawyers and accountants and financial advisors even, they have these boards where there's SICA, which is the Institute of Chartered Accountants. They've got Law Society, they've got Financial Planning Institute. So if you work hard and become a member of a board or a member of a body in your industry, then that warrants more money for you because you are seen to be more competent compared to your counterparts and so on. It's quite important for you to study more and apply yourself more and climb the corporate ladder essentially. However, if you're an entrepreneur and you make your own money and you're not employed, in the context of then offering your services and entrepreneurship, being more valuable means you can charge people more money for your skills and expertise in your business. And you can become more, which will help you actually make more money, because if you have more skills, then you can expand your packages perhaps that you offer in your services. And another important thing I want you guys to notice is that in the 21st century and in the modern day of the internet and the information age, we see that more people actually earn money by simply being themselves and being authentic online. From speakers to musicians and artists and social media influencers, people are finding ways to make money on and offline through their personal brands. Also, it's quite important then to cultivate a brand. If you want to make money from your personal brand, you need to be someone who has influence, someone who has a following, someone who has an audience that is able to listen to you, a tribe of people that are able to listen to you. And you can then offer services, speaking services, you can offer digital goods, you can offer consulting to these people, you can offer different services to these people. So being more skillful means that you can charge people money for your skills and so on. With that said, let's move on to wealth creation tip number 6, which is the final one. This one is about starting your own business. So starting your own business is the final strategy in this list. And it's a bit hard because it requires a lot of effort from you, the person starting the business. The first part of this would be the starting point of identifying the business sector and industry you want to do business in. In other words, you have to come up with a viable business idea. Phela kubalulekile la ukuthi uma uqala business, you must know what business do you want to start. Ufuna uqala business, ufuna ukwenzani. It's quite important for you to know that. A lot of people struggle with this part of identifying business opportunities, so I've got a methodology for you that will help you. I suggest using a value chain analysis, a supply chain analysis for generating your business ideas. Industries in the value chain and in the supply chain are categorized as according to 3 levels, which are the primary sector, secondary sector, and tertiary sector of the economy. So let's break these down. The primary sector of the economy deals with the production of raw materials and deals with the working of natural resources such as land. And examples of companies here would include mining companies and farming companies. Secondary stage, or the secondary sector of the economy, deals with the transformation of raw materials into finished goods, transforming natural resources into finished products basically. And the tertiary sector of the economy deals with the supplying of services to businesses and consumers. So you have to understand the whole value chain of the products or service you want to offer, and understand where you can be in this value chain, and understand what happens throughout the value chain of that product or service. So if you feel you have no funding, it's quite important to do this also, because you can first start high up in the value chain of your industry. So let's take an example of someone who wants to have a chicken farm business and to have chicken eggs basically. So you can start by selling eggs first from sourcing them from your suppliers and then selling them to end customers. So the end goal for you, you want to have your chicken eggs basically. So you can start by selling eggs first, from sourcing them from your suppliers and then selling them to end customers. So the end goal for you, you want to have your own farm where you have chickens that lay eggs for you, but you don't have the resources to have this farm. So what you can start doing is you can start by selling eggs to end customers. You can source the eggs from suppliers and start selling them to end customers. During this process, you're learning about what types of eggs people like. Do they like them boiled? Do they like them fried? Different things. How many eggs do people buy per week? Where do they buy them, and so on? You're learning different things at this end of the supply chain, at the tertiary parts of the supply chain. Once you have money now, you can then reinvest the profits and set up a chicken farm and grow your own chickens, which will produce eggs, and you can start supplying other businesses. Once you know about the consuming of eggs and so on, and you've got money and you've been selling these eggs to people, then you can start having your own chicken farm where you can have your own chickens that can lay eggs for you. Alternatively, if you don't want this long and piecemeal approach, you can just start a less capital intensive business. You can start a network marketing business, use the likes of Avon, Justin, Tupperware. You can get the benefit of a reputable brand at low costs, because if you look at a company like Tupperware, a company like Avon, those are reputable brands, and you can get all of those, access to those brands at a low cost, as opposed to, for example, a fast food franchise outlet that you would franchise. This is a reputable brand, but it has high startup costs and so on. Also, if you feel that you don't have money or funding to start your business, I've just shared the first thing you can do. Start high up in the value chain. And you can also be a DIY, do-it-yourself person. You can register your own business, open your own bank account, do your own things at SARS, and avoid paying services and fees to people and so on, if you've got the time at least. But if you don't have the time and you have the money, you can pay people to do these things for you. But if you don't have the money and you don't have the funding, you can do all of these things yourself. So that was the first part, identifying the type of business you want to start and looking at the supply chain activities of that certain business and identifying where you want to go in the supply chain. And the second part is about choosing your form of ownership, the legal structure that you want to set up your business on. This is very important because the form of ownership you choose to start your business is influenced by the type of business you want to start. So if you want to start a professional services company, such as a legal firm, for example, you would be required to register a personal liability company. And you also have to think about who do you want to trade with. So if you want to trade with the government, you'll be required to have a registered company that has tax clearance certificates and BA certificates and so on. It's just the nature of the government and how they trade. However, if you want to start a lifestyle business and a business around your skills, maybe speaking or an online business and so on, you might choose to trade through a sole trader, from which case your profits would be taxed at your marginal tax rates in your own hands and so on. And it's quite important that you want to have a lifestyle business and so on. And this will inform the type of form of ownership you will take and how you will pay yourself through dividends and those drawings and how you will be taxed. Quite important for you to know that. In closing, I'd like you guys to just take note of your wealth creation activities. You must know your marginal tax rates. Tax is very important when it comes to wealth creation activities. Know your marginal tax rate. Know how much you are taxed and the tax benefits of all of your investments and so on. Ask your financial advisor. So to recap, the first strategy was being more savvy about your money and interrogating your budget and so on and creating a budget. The second tip was becoming a giver, and it's either becoming a philanthropist if you have a lot of money. We wouldn't mind that. The third tip was using all your tax breaks that you have with the South African government, with SARS, using those tax breaks. The fourth tip was investing in the stock market, investing in financial markets. That's where you can create wealth. The fifth tip was becoming more valuable. The fifth tip was about becoming more valuable so that you can charge people to access your time, to access your skills. And the sixth tip, which I was talking about now, was to start your own business. Start your own business. And if you start your own business, then you won't answer to anyone. Then you'll also be fully in control of your wealth creation activities. And yeah, man. Start your wealth creation journey, man. Speak to a financial advisor. I'm also an advisor. You can speak to me if you like and access my services. If you already have an advisor, do speak to them. I encourage you to do that. And open your investment account. Start creating wealth. Start writing up a budget. Start with those small things. Start giving. Do all of those things. Start pursuing your business ideas. Jot them down. Apply them. So all of these things will take time. So you need to monitor them over time. Being valuable, if you want to be more valuable, requires you